good morning, everybody. Thanks very much for joining us here. Thanks very much also to Filip and the team from Ashurst for hosting. And let's just start with some quick introductions. So you did a very brief welcome, but let's do a quick introduction of you, Filip, and also Ashurst, just so that everybody in the room knows what everybody else is doing. So we'll start with you and work our way down.
Ashurst is an international law firm. We have 30 offices all around the world, and there's more and more coming. We recently opened one in Morocco, so Africa is now a continent where law firms seem to be expanding. What I can say about Ashurst, which differentiates it from many other big law firms, is that real estate has always been and continues to be one of our focus areas. Real estate and real estate finance. We have partners and teams for both areas of law in all major jurisdictions. So the deals we like to do are international deals or more complex transactions involving real estate and ideally also a financing element. So,
first of all, thank you, Filip and Richard, for hosting us today. My name is Simon Schödel. I'm a vice president in the investment team at Starz Real Estate, a pan-European debt fund focusing on the mid-market. I started my career at MEAG, the investment manager of Munich Re on the real estate equity side, and joined Starz in 2018, 1 month after its launch. Since then, we have invested over €1 billion in whole loans across Western Europe, the UK, Ireland, and the Nordics. And yeah, I look forward to a great discussion.
Good morning, everyone. My name is Nicole Jürgensen. I'm with Münchener Hypothekenbank, based out of Munich, as the name suggests. So as the name also suggests, we're a mortgage bank. Means we hand out senior loans to be secured by a mortgage, and we provide senior debt in the areas of core and core plus prepositions in the first place. I take care of the international clients, and thanks for having me today, Filip and Richard.
My name is Jürgen Helm. I'm with PGIM. I'm doing real estate lending and real estate investment banking since 28 years. And I'm heading the European team of origination at PGIM Debt. PGIM is a bigger real estate platform, as you might know. We have roughly 110 billion also in debt outstanding. Majority of that is US. And we are doing Europe core plus and value add debt as well, yeah.
My name is Patrick Züchner. I'm Chief Investment Officer of Aukera. Aukera is an investment boutique based in Essen, doing real estate debt only. I've been socialized in the CDO business on the CMBS side before, so before the financial crisis. Then I moved over to the investor side. I've been head of real estate within Gotha, and then part of the Gotha team in 2010 thought about whatever, it's a good idea to create a German-speaking manager and to set it aside, that the UK guys, which funded themselves some years ago. And since then, we've been in mainly whole loans, and the team raised and invested over 4 billion in the last cycle. And I think this is the beginning of a new cycle, so it's a perfect time to meet and to let you know what we think about.
Let's start with a first question, but before we do, again, great group here. So if you've got questions, if you've got thoughts that you want to contribute, please do, because it's a small enough group. Just you don't need to ask permission, just ask. Indicate to me that you've got a point that you want to raise or a question that you want to give, because it may well be that you've got different questions to the ones that I think, so we can pick up on those. We also did a debt finance session at Expo Real, so I'll also pick up on some of the things that came through in that, so that again we have a connection with both of those sides. But it would be interesting just to pick up in terms of the perspective over the last 12 months. What do you see as having changed? And let's pick that up with everybody, but why don't we start with you, Nicole, if we can. So just your perspective on what's changed, what's different.
I would say one big advantage is the fact that the interest rate environment has, to a certain extent, just stabilized. I mean, it gives our clients and us as bank, at the end of the day, the possibility to model our cash flows with a higher level of accurateness. And so, that's a good environment to start from. Apart from that, I wouldn't say not that much has really changed. So far, this year has been challenging in the sense that it's really difficult to find new deals that make sense for the bank. So we're, as we've been doing over the past, I would say 2 to 3 years already, we're mainly focusing on refinancings, maybe taking out other banks and providing loans. But as far as new transactions are concerned, it's still quite scarce. And I hope this is going to change now that we're seeing a new cycle start.
Okay, good. I'm interested to get other people's perspectives. Does everybody agree with that? Have you got a different perspective? What's changed in your areas?
Yeah, I can build on many things you have said, Nicole, but I think the hope of a market 12 months ago was a little bit that we get more tailwind from the interest market. This is a bit gone as well, yeah, so we expect a sideways trend on the interest market, not interest will go down further, so I think that's more realistic now, that people are expecting now not so much support from the interest side, I would say. What is still a problem, I would say, especially with the German market, as you mentioned, is the lack of transactions. There's a lot of people running around like us, debt providers, but not so much people running around with deep pockets of liquidity for equity. And I think that's still especially the challenge in Germany, France, the big markets. UK is much better, Netherlands coming back. We have seen more deals. You also mentioned that, yeah. So, but this is still lacking behind, I would say.
I think the difference for the German market is that the equity liquidity is still a bit greedy. So liquidity is still in an IRR range, which is not that rational if you look for German real estate. And on the institutional side, and I mean, institutional investors, don't forget, even if you start with covered bonds or with Pfandbrief, it's driven by them. And it ends up with debt funds and equity funds. So more or less, a lot of money, and I don't know how many percentage, comes from institutional investors. So this liquidity came back the last 12 months, but it's still reluctant, unfortunately. And on the other side, you have this very greedy equity, which is able to invest, but again, maybe do a bit overshoot on the pricing expectations.
Okay, good. Simon, yeah, go ahead.
Yeah, I would agree with all of what has been said. I think one factor that changed is also kind of the shift of capital flows to Europe. Like there's more of an interest given geopolitical events, even if it's just a small part of what has been going to the US is now coming to Europe, and even if it's just 5%, that's a big number we're talking about. So the interest is there for European real estate, and there are green shoots, like, for example, in the UK, I would say the market is further progressed towards, adapting to the new interest rate environment and just getting deals done. There's more eagerness. I think it's a bit more wait and see in the continent. But as mentioned, I think we also see markets in the Netherlands where there's more and more coming. But yeah, it's still mainly refinancings.
Okay, good. And Filip, you're obviously seeing things from different perspectives. So just in terms of changes, and happy to drill down into those later, but what are you seeing? Are there any broad changes that you've seen?
I mean, what we see is an increasing number of debt funds waiting to deploy a considerable amount of money in the German market. And sort of the challenges, and we had some discussions on this, the challenges are to find the appropriate products, if you want, and objects. So there's enough money. The challenge is, to find an appropriate match which allows the debt fund to have the return they need, and which does not. And which is which can be digested by the property in question. So I think there's still some sort of mismatch between fairly expensive money waiting to be deployed, and not so many properties that can accommodate that money, but there's no alternative basically, or there's few alternatives in between the sort of cheap senior loan financings and the rather expensive debt fund financings. So that's a gap I think we need to close somehow.
Okay, I'll pick up on the debt gap side because I think there's an interesting point around that. Just in terms of the interest rate cycle that we mentioned there, where are we with that? Do we expect that to change? How's that going to influence the market? Maybe Jürgen, let's pick up with you on the interest rates and I guess where you see that heading if we look towards 2026 and how you see that as influencing things.
Yeah, so from a bond market perspective, we expect a more flattish development over the next 12 months. Yeah, so US 10-year around 4%, German 2.5% or so 10-year money. Yeah, so German state bonds. And as I said before, I think the hope that the interest rate will drop is gone more or less because there's so much debt needed. All the numbers, France state, etc. There's a lot of pressure. And there's a lot of money needed to fund the states, and so we expect not a big tailwind from this market. However, we see more tailwind from a market that we have a little bit over deployment of over allocation in debt products compared to equity. So the debt products are getting in much more competition. We are seeing it every day. Just lost yesterday a deal by 50 basis points. Yeah. So, and I thought that my pricing was quite adequate for this product, but it looks like, and I lost it against an American player. Yeah. Just to give you some sense. Yeah. So was not a German Hypothekenbank or so. Yeah. So there's a lot of competition on that side. So this helps also the market, I would say. Unfortunately for us, not, but for equity, I would say.
Yeah, go ahead. Yeah, I mean that's quite interesting because one of the things in the session that we had at Expo was Duco Mook, who's on the borrower side at CBRE Investment Management, was saying that he's getting a huge difference between spread between the offers that he's receiving, and that for him for certain things. For them as a borrower anyway, it's very much a borrower's market. But that's interesting that you mentioned that, Jürgen, that you felt that was priced correctly, but actually there was a big difference. So interesting to pick that point up from anyone as well. But go ahead, Patrick. Sorry, I stopped you.
No mind. So as I've been on the institutional investor side, of course there's competition between asset classes. And in beginning of the summer, there was a lot of liquidity also concentrating to private assets. Because the crisis seems to be over, interest rates on the fixed income side declined, but then French government bonds increased on the yield side for 30 years to 4% area. And this is really something where you have liquid product with 4%, it's relatively hard to get attraction for illiquid private debt products. So sometimes it not depends on base rates or something like that, but it's opportunistic costs and opportunistic asset classes which drives liquidity into the real estate financing market or not. And a single event like this, a yield increase on the French government bond side, changed immediately reactions from investors looking for signing commitments on that fund, at least on our end, which is okay because it will change anyway in the other direction. Interest rate environment has some affordability angle on one side, like we already mentioned, for the real estate able to pay the debt service. But on the other side, at least for me, doing fundraising, this is important to look at opportunistic costs and opportunistic asset classes.
Okay, good. It'd be interesting to pick up on, I suppose, some of the challenges that we're seeing in the market, both in terms of Europe, but also here in Germany. Nicole, let's just start on, certainly complexity, those kinds of areas were coming up in the session that we had at Expo. So what are you seeing as some of the challenges? You mentioned things are slower, that there's less transactions, of course, but what do you see as the challenges? And I suppose, do we see anything in terms of the solutions to those going forward as we go into 2026?
I would say that one of the main challenges is effectively the fact that there's loads of institutions chasing not necessarily the same product, because most probably I would not pitch for a deal that you would eventually lose, because we're like in different worlds and we're totally targeting different kinds of assets and situations. And what was I trying to say? It definitely takes longer. Let's pick up on that. It definitely takes longer. There's a lot of competition going on, again, particularly for core propositions. And coming back to what Duco apparently was mentioning, it's obvious that if you have that much competition all chasing after the very same product, then you see there's a huge bandwidth, because at the end of the day, you might not really focus on your gut feeling or on the numbers making sense, but you just want to take the deal because you need to keep your people entertained. So, yeah.
Okay, good. Does anyone else have a view on that? I mean, interesting that there's different sources of new capital coming in. Even if you look into Europe, obviously, somebody, a house like Rudevco through acquisition, but buying out a financing house so that then they can offer debt, private debt, as one of their suite of products. So, what do we see the influence of those coming in? You mentioned as well US capital, Simon, but interested to get your views on that.
I think one of the challenges is also that there are few transactions, like acquisitions. So you have not a lot of anchor points where you can get a sense for the pricing, where the market is at the moment. I think here in Frankfurt, we're sitting in a building that's on the market, and there's another one in Frankfurt, which is in a different kind of spectrum from a risk perspective. And those big transactions, like those are missing to give people an idea where the certain market segments at the moment, and is there the money? I think for us, we're more in the value add area active. There's also for our borrower sponsors, there's kind of the core capital missing that they need for the exit. So that makes it harder. And then I think, low transaction volumes plus everyone is focusing on a few sectors. I think where you then have the massive competition between lenders, which is making it harder for everyone to get deals on the book and deploy capital.
If you ask for complexity, I don't think the complexity for the of the financing market today is a problem, because various sources create a lot of liquidity, technically and theoretically. I think the complexity of the German financing market between 2019 and the crash, let's call it a little crash, I think this complexity now is like a bubble gum in the market. Because the complexity was, for example, the deal of the year of, I think, 2020 is now back on the market. It has a senior and 5 layers of debt above. 5 above the senior. The senior is accepting now a haircut of 20%-ish, if I read it correct yesterday. And we do not speak about the 5 layers above. The senior takes a hit and the rest is gone anyway. But the rest is with investors which are not trained to decide. They don't have the team to decide. They don't have a work stream to decide. They don't have managers able to take care of the complex situation. And this complexity of the latest years of the last cycle is a bubble gum for solutions now, I think.
Okay, good. Go ahead, Jürgen.
Yeah, I think that's a good point. Yeah, so there's a lot of debt going into refinancing situations now. People having this debt outstanding, not used to work with debt, to be honest, because we have done in the past other things like German pension schemes, etc., and they don't take decisions, and that's why I would say we have unsolved refinancing issues, and we spoke a lot about this liquidity in the market. I think there's a lot of debt. You can provide a lot of debt. We can provide a lot of debt. You as well. But there's a lot of unsolved situations, and people have not recognized yet. They have to take larger hits to get it working again. And that's a problem. Is people are not able to take a decision.
I would doubt whether they all know about the risks on their books already. To be honest.
But that's a really problem, because normally it's a commercial real estate lending is a professional market, I would say. People who do commercial real estate lending should understand what we are doing, but it looks for me in the last years one of the issues regarding mezzanine in the German market. We have not done so much mezzanine in the German market because the German mezzanine market was different to our other markets. Yeah, we have never changed our IRR for mezzanine the last 10 years. Yeah, it was over 12% plus. Yeah, and we did not do mezz in Germany because there's other mezzanine lenders providing German mezzanine for, let's say, 7-8%. Yeah, and it looks like that these people having now this issue.
I mean, that's an interesting point. I mean, there was also a pickup in terms of that with, not so much actually during the session, but in the call beforehand with speakers, which was around, you know, that German mezzanine was never mezzanine in the first place, and it's just misnamed in essence, and that there are problems with that. But Filip, I'd be interested to get your point on that, but also, I mean, Jürgen mentioned there the situation in terms of, you know, issues with loans. There was obviously discussions about the debt gap. We had a special presentation on it 2 years ago, I think, at this session. To me, that seems to have disappeared from the conversation, but I assume it can't have disappeared from the reality entirely. So where are we with that, and what's actually happening on the ground?
Maybe on mass lenders. I mean, we've been advising many of them in the last years, and we've been talking about ICAs and all kinds of situations that could happen. And then in the end, if we look back, I think we have to conclude that most of the security and the structures and protections for mass lenders just did not work in terms of that the second ranking mortgage, which seemed to be a good security, just doesn't make sense except that it may create nuisance value. And I think the underlying problem is that, as you said, Richard, the mass lenders basically came in as like senior lenders with a slightly higher return and with second ranking security, but most of them were not prepared to take over the property, to take over the shares, even though they may have been able to do that easily. You know, in Lux co-structures, they were able to enforce their pledges within a couple of days, but most of them did not do that because they did not have anybody to run the business, or were afraid of liability risks. And another issue was that the funds that gave the money were closed, and there was nobody who was able to, or who was willing to give additional money for the debt fund to solve the issue. So we ended up in various transactions. We ended up in a deadlock situation where nobody was willing to give a small amount of additional money to stabilize the property, and so we had to find new players who would come in first ranking with a first ranking land charge and with double-digit returns, which, you know, from a legal perspective, that sounds like a good deal for such new money.
I agree for the later stage of the last cycle, but not for the beginning. So as we moved as Gotha team and created Keros back in the day, the first fund was a mezzanine fund, and we deployed a number of loans in Germany and later also in the Netherlands. But then there was one deal with PBB on the senior side, and I know Andreas Würmeling for a while because the CDO manager was also part of this group I've been before. And it took us nevertheless 1 year to close the deal with a large German asset holder. So the mess took us a year, and it was prepaid after 1.5 years. So it was a bit, useless. And this was one of the reasons. And the other reason was, at this point of time, this was 2014, intercreditors with banks have been quite okay from a mess side. But it started relatively quickly that they did not accept it any longer what we really thought we needed. And therefore we changed the strategy away from mess to whole loans with a relatively high return, not double digit, but nearly. So to supplement poor mess positions by stronger whole loan positions. But what you describe, this happened as the interest rate environment really came down significantly, and it was relatively easy from 2018 going forward to raise relatively uninformed German money and to put it into so-called mess, which was not even mess, but junior, whatever, pref equity type of risk. Yeah. So I think we have to differentiate in the cycle. In the early stage, well-informed investors always come in, and in the later stage, it's kind of a peak cycle. You can see in every financing market, every capital market. In the later stage, the uninformed investors drive the market and lengthen the cycle by at least 2 or 3 years, like it happened this time again.
Okay, good. If anybody else wants to come on that, do, especially whether or not we're going to see more MES coming through, because that obviously has been an issue in terms of the financing side. Do we expect that to increase? How do we see that working? Anyone got a view on whether we'll see more in 2026?
I think whole loans provide a good opportunity. You don't necessarily then need the mezzanine because you can go higher than a senior, but that's in hindsight. We did a good job not participating in the German market a few years back. So I guess, it's always the question for us as a lender, what risk are you willing to take? And are you willing to go 90% LTC? Do you still deem that to be mezzanine risk? Is that, adequate for a whole loan lender? Where do you want to be? And are you willing to take that risk? And I think one issue was also, as mentioned, people took that risk without knowing what exactly it means. Like what that risk involves, what could happen if things turn south. And I think there's a big gap that needs to be filled. I guess it opens up opportunities. There are investors interested in those stranded assets. I think we have lots of developments where, they came to a standstill, they're not yet finished, and that also opens up opportunities for new investors to come in.
Okay, good. I just wanted to pick up briefly on just the maybe Patrick, let's start with you on this, but I'd be interested to get the view on what's happening in terms of capital raising for debt. I mean, we all mentioned that there's a lot of capital waiting on the side, but is it still attractive in terms of the institutional capital? Are there more debt funds being raised, more entrants coming into the market? What are we seeing? Is there going to be even more money coming in 2026 into this part of the business?
Well, if I speak for debt funds only, because as I said, covered bonds is a starting point for them for real estate finance investments. But let's concentrate on debt funds only. In the last cycle, it was a pioneer product. It was in Europe, never seen before. It was, let's say, the supplement for CMBS 2.0, which never happened. So it was just another approach, but an active approach instead of a passive approach. No? And even if this was a pioneer segment, and in Germany, fundraising back in 2014 was quite tough, to be honest. I don't have any doubt that in this cycle it will be much more. There is demand anyway, and a lot of investors learned negative lessons in the later stage, but also positive lessons they heard about of private debt, private real estate debt. So I have no doubt that it will be at least double the size of the latest cycle. I don't know the exact number for debt funds, but it's some tens of billions. Even if you compare with the banking industry, it's quite small. But I think it's attractive enough in this cycle to increase the volume by at least 2 times the last cycle.
Okay, interesting. Yep.
I just wanted to briefly add that I'm really surprised about the sheer number of institutions suddenly popping up and offering debt products. Private equity companies based out of London, obviously, in the first place, but also across Europe. They've only taken a look at investing the money on the equity side and suddenly say, oh, by the way, we've also hired debt people. And so we're going to start doing this again. Of course, again, not as our direct competitors, but this is what I can see.
Okay, good. Simon, did you have a view on that?
I think because you have those underlying trends, like if you look to the US, the market for the alternative lenders is way bigger, the market share, compared to the banks. If you look to the UK, again, it's growing. Debt funds as part of it are growing. And in continental Europe, we're always a bit behind, I would say. So with new regulations coming in, Basel III, Basel IV, like banks aren't as willing, I would say. So there's someone to fill the gap. And there are debt funds, there are other institutions who come in. But yeah, I agree with Patrick. I think we'll see growth on a large scale.
Can I add a bit? I think we are at the moment raising our next value add fund for Europe. Yeah, it depends where the money is coming from. Yeah, so and I would say there's still a high interest from American or Anglo-Saxon money or Middle East money or Asian money to invest in different type of debt products in Europe. I would say still the case. And it's a little bit more challenging for some of the Germans, I would guess. Yeah, German institution people have lost some money in the old debt funds or debt structures. But there's money for all type of lending. The problem I would still see is more, I think, for new financing, new setup, even if it's more speculative, it's more redevelopment stuff, people are willing to invest also on the debt side. It's more challenging for the, I would say, with the hopeless refinancing cases at the moment. Yeah, nobody wants to touch them really, because all people are out of the money. They have not recognized it yet. Yeah, and new lenders are thinking more, okay, this is a problem of the old lenders. They should sort that out, not we. Yeah, so it's much more difficult, also in-house with our team, for example, to look into a refinancing situation compared to new, fresh financing where people bring new, fresh equity to the table and try to solve the problems.
I really like the idea of a new sector called hopeless refinancing. Maybe we should do a very specialist event just on that, on hopeless refinancing. Let's pick that up a little bit just in terms of, I suppose, there's plainly liquidity in the market, but maybe not for everything. So who is borrowing, who is lending, and on what? And also, I guess, where are the challenges in terms of lending? Where are the holes? I mean, you mentioned there, Jürgen, already that there's an issue with some of these problems with refinancing. So what happens if something doesn't tick all of the boxes? I don't know who wants to start on that one. Anyone can pick that up. I mean, maybe Nicole, let's start with you just in terms of what you are lending and what you're definitely not lending on, and then it'd be interesting to see what everybody else's perspective is.
As I said at the beginning, we clearly focus on core and core plus propositions, and really don't take a look at value add or even opportunistic stuff. That's far too funky for us. But as I also already said, in the core area, it's really difficult to find deals. So what I've learned is that you can't tick all the boxes these days, and so there's at least one box that you need to live with, and you need to find peace with. And so a good example might be a deal that we signed just last week, but so on our way to closing. And it pretty much ticked all the boxes apart from the location, which, you could argue it's the most important thing about an asset where it's located. But at the end of the day, we came to terms with it. It's not in the very city center of one of the 4 big Dutch cities, but it's okayishly located so that it compensated so that the rest of the factors could compensate for sort of the quality and the location. And this is, I think, the only way that we right now, as a core plus lender, can find business. We can't expect the world to be perfect, and because it definitely is not. And we just have to find, a compromise that we can live with.
And does this also mean, focused on, let's say, the core standard sectors like logistics, living, even retail, for example, or does that also then mean that you're prepared to move into some of the more alternative sectors?
I mean, that's what we actually did, because again, we need to look out for the right product, and of course we need, all of us here, we somehow need to engage in building up new business, and making sure that the business that you have at hand stays where it is. But so we're moving into new sectors where our board has just approved us being able to provide loans for healthcare situations. 2 years ago, we started to go back to the development sector, and we're taking a look at data centers. And I mean, we're a mortgage bank, 128 years old, so sometimes stuff just takes longer to be digested in the in the organization. But I'm sure that eventually we're going to be there, and also being able to provide loans for data centers. We're still struggling to get that done.
Okay, good. I'd be interested to pick that up with others. Philip, let me just start with you though. Just in terms of what you're seeing, are you seeing appetite across all of the areas? Are there some things that simply, take forever in terms of the transaction to go ahead? One of the topics also was that, again, from a borrower's perspective, it was where they felt that they'd got, this was a great one, but it just didn't tick one of the boxes. And so what that appeared to them to be a great asset, suddenly nobody wanted to finance. So it was a mixture between everyone wanting to finance it and then suddenly nobody wanting to finance it. So I don't know if you've got a perspective.
Yeah, I think that's what we get, channeled back from borrowers or debt advisors. There's people who are desperate because they say we have a good property here, which may even be fully let, but which may need some capex here and there, and there's nobody who wants to finance or refinance it, and and on the other hand, if there's a core plus asset which ticks all the boxes, then everybody wants to finance it. So there's there seems to be a big mismatch between properties that everybody wants to finance and other properties. And other properties may be difficult properties, but may also be properties that just need here and there some extra work, but that may not be so difficult in the end. And for the latter, I think we will need to find products in the market that may come from traditional banks or that may come from debt funds, but which I don't think are yet as prominent as they should be. So traditional banks could, for example, come up with new products that have a higher risk return profile, and debt funds may come up with new products that have that have a less IRR requirement, a lower IRR requirement, but maybe from risk profile may be attractive as well. So I think that's.
So you see new products coming in as a way of solving some of these issues that there are currently in the market.
We do see that. We see cheaper money from debt funds. What we don't see so much is traditional banks coming up with more with newer products yet. But we do see interest in such products. We also from speaking to traditional senior banks, we also see interest in providing back leverage to funds, for example. And I think we should talk about back leverage also in this discussion. But we don't see it yet coming from German banks, at least. So.
Okay, who wants to pick that? I can see that. Patrick, let's go for you, and then I can see you're keen to pick this up as well, Nicole.
Yeah, I think you have to choose your strategy from both sides. So think about wisely, what do you propose to your financing source, to your source of money. So our base is institutional investors in Germany. So what do you really give them as a target of your return, which is really important, because if you overshoot, you will struggle investing. If you undershoot, you will not get money. So this is A. And B, you have to know what is the structure of your competition, because as a debt fund, you obviously are more. So you're not as cheap as the banks, so you have to find a niche, and the niche is very variable, and it depends on various topics. For example, region. So if we think that Germany is a bubblegum market, we go to the Netherlands. Why not? If we think that over 40 million, the back leverage game starts slightly. And back leverage is, of course, a tool which a borrower has to understand the pros and cons. On the pro side, it can be much cheaper. on the con side, the party you speak with may lose the driver's seat later on. So it has to be well understood. But if you try to be out of this game, like we are at the moment, so we totally decline and work without any back leverage for good reason, because German institutional investors don't need that high returns, and they also starting to understand the product of back leverage and try to avoid additional risk for now. And let's see. Then we concentrate on smaller volumes, which is again a niche, between 10 and 15 million at the moment. Literally no one other than local banks is active in the financing market, which is for us quite nice. It's a diversification product, the starting point to attract capital from institutional investors back in the cycle, to create also with smaller ticket sizes a nice portfolio. So this is the niche at the moment, but it really depends. It depends on where the competition moves. Yeah? Let's see.
Okay, good. Nicole, yeah.
No, I just briefly wanted to add to what Philip just said. So I think it's rather, it's more likely for banks to sort of broaden their product range in the sense that they might think of adding new asset classes as part of the strategy, but not moving up the risk curve, particularly not with all the stuff that you have in your books that special situations groups need to take care of. And as long as this has not yet been digested, banks are definitely not going to move up the risk curve. And there's also the regulator taking a very close look at what we do as banks who are regulated by the ECB, and not going to happen.
Okay, good. Simon, interested to get your views on that, but also on the point around some of those newer sectors, some of those niche sectors where there may be more opportunity.
Yeah, I think overall we as Starz, we're pretty sector agnostic. So for us, it's about is it the right product with the right borrower in the right market? And we do see some hot sectors, some of which you could call new alternative, like self-storage, and then also alternative living. We see growth there, I think. Some of them are, in our opinion, specialized, and with data centers, the question is, where do you come in? Is it the land banking? Is it the dark site where they just provide more or less a warehouse? Or is it the fully built and the tenant just moves in and adds their server? So, where do you get in? What part of that market? And there's a lot of capital obviously flowing into that. And do you get, the right risk return profile for that? Like, are the leases long enough? And like a lot of questions, I think, need to be answered in that sphere. But yeah, overall operational real estate, I think, is a theme. We're seeing lots of hotels, also with residential, micro apartments, serviced apartment, co-living, where you have more of the operational aspect in there. And it's certainly growing. I mean, then there are the demographics which drive that, but also on the other end, senior living, where you do need to find housing solutions for our population, older population. So yeah, there are different factors driving it, which I think we see more product, but for us it's about finding the right product that fits our profile.
Okay, Jürgen, and feel free to pick up on some of the more traditional sectors, let's say, as well. Is there a real match between what the equity capital is looking for and what the debt would like to give, or what, is there a real, are you in tune with what's happening on the equity side as well?
Yeah. First of all, we love to finance new acquisitions. Yeah. So we are happy to follow the equity, but in principle we have following. I would say the big macro trends. Yeah. I would say, yeah. What is needed now? Yeah. We needed a lot of type of residentials. I would say everybody understands there's a shortage for residential, from traditional build to rent to micro apartments, student housing, etc. So I think that's a big topic that everybody is looking at in the real estate sector. besides that, we have also the other big trends like logistics. Now there's a discussion about the defense sector, needs new logistics. There was a headline in the morning, 30% prices up in some logistics, which I don't see yet, but it looks like with these big trends we have to follow. There's a big discussion now in Europe about storing more stuff here on the ground to keep our industry working also through a cycle or through a shortage of material coming from other markets. So I think these are the big trends, and on the office market also coming back to some extent, I would say, like this nice building is now for market. But so we follow the equity and I think these are the big trends. It's difficult sometimes to go into total different markets, like what you're doing in healthcare. I think you have to understand this subsector very well. So sometimes you have to think, you have to choose your fights and you choose your options, because as a small debt fund team or whatever you are, you cannot capture everything. You have to choose what you are looking for. And if you're a bigger bank balance sheet, you can go into more different markets. But operational asset class, I would say, is in principle interesting because it's getting more important, and we are, as a US house, more used to more operational risk taking. For example, we are a long time in self-storage in Europe, which is, I would say, perhaps a niche market for you, Nicole. I don't know. Okay. But we know the markets since decades in US, so we have some experience with the asset class, so we can work a little bit more with this asset class as well.
Okay, good. But at the moment, it looks as though it's only Nicole who's going to become a new member of the Senior Housing and Healthcare Association, I think. Good. I just wanted to pick up a little bit, Patrick, from your point of view as well about the sectors. Obviously, we're seeing bounce. If I'm talking to investors at the moment, I'm seeing a big bounce back in terms of retail, particularly if we're looking partly in shopping centres, but also particularly retail parks. So how do you see, the more traditional sectors, the logistics, the office, for example? How do you see those?
Opportunistic approach. Every single property has to function within the market it's in. And if a shopping center is relatively poor and nearby a better one, then obviously it has a poor position. But if it has a good position, that's also fine for us. So of course there are sectors which are more driven by macro trends than others. But again, I spoke about being in niches. And if office these days is not financed at all, also not with ESG capex programs of 10-15% on top of the purchase price, why not jumping in as a debt fund? If the product at the current state is quite okay positioned in the market, and position will be even better following the program on the active approach of the asset owner. So following macro trends is nice, but everyone is try to follow macro trends. So what we always did is following the counter of the competition. So in 2014, no one financed hotels in Germany. So we did. Just to give one example, so we not behind the macro trends. We are behind where the competition is less, because there is the higher return on the same risk for us.
Okay, good. And one of the other points that we were getting a lot in terms of when we were having the more investment-focused discussions was it's much more difficult now just to make money by buying and selling. That actually, therefore, you've got to know, you can't just buy logistics and say that's going to work. Actually, it depends on what the location is, what's happening there. So does that make also that more difficult from a lender's perspective in terms of being able to value a specific asset or a portfolio, because there's more of a focus on individual assets rather than buying a sector, let's say? Does that influence?
Doesn't it depend on the availability of the sponsor to deal with the situation? And it was always the case. Of course, you could have give in 2020 someone money buying a property like that, and you may have lost money. It depends on the LTV. But isn't it always the better case in every point within the cycle to finance some kind of active approach instead of just hoping for value increase in the overall market? So we always try to and will do as well in this cycle. And maybe not the answer you like to hear, but yeah.
No. I like to hear all answers.
Yeah, but I think it was we had a decade of times where people make money out of real estate without knowing too much about it. I'm being a little provocative now, yeah. So because you just bought an asset and 5 years later it was 20% more higher value, yeah, because of yield compression and all this stuff. And I think you're fully right, yeah. It's all about people and it's a people business. I think today, in our opinion, we are looking a lot about who are the people investing, yeah. Are we the right people for this asset class, yeah? Do we have the right asset management team on the ground to cope with the asset and to bring value to this asset? Because yield compression is over a little bit, I would say, yeah. Might be a side trend or so, but I think it's getting, it should be obvious that we look at that, yeah, but it looks that this is now much more important going forward.
Okay, good. Simon, do you want to pick up?
Yeah, I mean, I agree with both of you, and I think what is really important is the income profile, the resilience of the income. So people are, again, like, what you need active asset management for is to make sure that the income either comes if it's a lease-up play and you have the right people able to lease up the property, or, with CapEx, that it's spent in the right way to achieve whatever rents to make sure that you have this resilient income. And I think that makes it, or was always important, as Patrick said. I think it's not something that just started in this new cycle that we're seeing now.
And in terms of things like the CREM path, I mean, you mentioned resilience, those kinds of elements. How does that impact you in terms of when you're looking at a valuation? Because obviously you've got to look forward, whereas valuations are often looking backwards in terms of those kinds of things. So how do you see that when you're looking at a loan and the resilience of it? Does anybody want to pick up that side of it?
I mean, valuation, of course, is important, but what's far more important is the fact that the income that's going to be generated over the term of the loan is going to be able to service the debt, period. And then you automatically have like a cap, a loan amount, and that translates into whatever kind of loan to value. But this is then the one that can be digested by the property and the rental income it generates.
Okay, good. And Filip, from your side, it'd be interesting just to pick up, are we seeing, a lot of refinancings in order to decarbonise, in order to get assets back onto the CREM path? Is that a focus of the investment side? What are you seeing? Or is that an accident waiting to happen?
Yeah, I mean, I don't think so. I mean, if that was the case, then we would see a lot of new transactions, which we don't. So it's still about refinancings and the fight for closing the financing gap, but not so much in my perspective. But that may not be an objective one, and not so much something that would change the asset or make it greener, for example.
Okay, so less in terms of transformation.
That's my perception.
On the transformation side, I agree, but overall, it's still a bridge solution environment. So there is a lot of bridge ideas, bridging of time. There is a development which is 90% finalized, but of course the cost increased. The current financing party likes to step away because it takes longer, it costs more, and so this is a bridge to finalization idea, and of course there is also not an exit of a development being finalized this year. Maybe there is some in 12 to 18 months. So you need some kind of bridge to exit solution. So it's all about bridge ideas, and only part of the bridge idea is to enhance the value by ESG measurements. But it's of course important. It came a bit down. The attraction on it came a bit down, but it was always important to make sure that it is attractive to tenants also going forward. If you name it or type it ESG or sustainability or attractiveness of rental space, I don't care. But it was always important to have this on your SWOT agenda to make sure that it is attractive space in the future.
I think you're right with developments, but I think what has changed from my perspective is that also for acquisition financing, the past was always the acquisition loan, yeah? Just the acquisition loan, someone bought a portfolio. But now we see a lot of acquisition in the market, the acquisition loan, plus the CapEx tranche. And I think we as lenders have to be adapt more to this market, because a lot of people buying as a little bit dated, have good idea how to make them greener or more ESG eligible. And when they need CapEx for that, heavy CapEx sometimes. And so you see often, besides, let's say, a 100 million acquisition loan, also another 30 million CapEx loan to improve his asset over time. And this goes for, I would say, more or less every asset class. Yeah. And I think our capital needs to adapt to that a little bit more, yeah, because we are sometimes a bit unflexible when it comes to capex financings, yeah. And I think, but this is the need, yeah. We are in transition now, yeah. The whole market, besides development, has to be completed. Also, all existing stuff needs capex, yeah. We see it some nice examples when you look out the window here. Some bigger office here in Frankfurt needs a lot of capex in the next financing round. I'm just saying that. So I think that's important. And I'll give you also one example. I financed a Core Plus strategy for, let's say, secondary logistic assets just recently, and it was a big discussion with this client how to implement their strategy in the loan documentation regarding ESG. And finally, we find some compromise here and there are also some hard obligations to invest into, for example, heating pumps, stuff like that, in the loan agreement. Yeah, but it's always a decision case by case, I would say. There's no general rule for that. Yeah.
Okay, good. Does anyone have any questions here that we want to ask? Yeah, go ahead. Yeah.
Dear Schödel, I expect with real estate. Good morning. First of all, thank you very much to the panel. Great insight. Although we are an investment advisor, we've been asked by a UK-based owner of a big portfolio of social housing, backed by a 30-year lease contract with the government. We were asked to help find him German money, either via a debt fund or directly by a mortgage bank. What would you recommend such a lender, how to structure a deal? Just would you look at it, Nicole?
Definitely. Yeah, definitely. I mean, it's UK risk, right? So, yeah, it's a question of loan to value, and interest rates still high. So for us right now, it's really challenging to get the numbers around in the UK. And it's not only high interest rates, but also margins are coming down. So the UK market these days, for us, definitely no fun, but very happy to take a look at it. Sounds appealing.
Please give back the micro to Jürgen.
Tobias, this has surely got to be the easiest day's work you've ever done.
So UK market is a big market for us as well. Yeah, we could have a look at this type of product, of course. Yeah, on the senior lending side. Well, it's not so easy. The interest, the margins are in UK huge under pressure. We are losing a lot of deals in the UK market against the clearing banks, so the big local banks who are super strongly back on the senior positions. So it depends on the pricing on that, but in principle, this could be something we could consider, of course. Yeah. Not your market.
Anyone else have a view on those? Not your markets? Yep, go ahead.
I mean, we did social housing, but that's a few years back, and I guess as Nicole and Jürgen mentioned, like the margins, they wouldn't work for us right now. So.
Okay. And you already said.
Yeah, so it's all about competition. The UK market is by far too crowded. It was even in the beginning of the last cycle, so we don't touch the UK market at all, because there are too many players existing for too long. That you as a new entrant, even 10 years ago, we would have been a new entrant, so it wouldn't make sense.
Thank you very much.
Okay, good. Thank you, Tobias. Anybody else got any questions? Yes, go ahead. Yeah.
Maybe Patrizia Catanese from Morningstar DBRS rating agency. So your view on securitization. We are seeing flooring markets also for new issuance and securitized product. What is your view?
You mean securitization in the old style, so visible or not visible in the background?
No, CMBS.
So CMBS is now 3.0 or what is it? Well, there was a meeting in 2010 as I've been the head of real estate within Gotha with two guys from Deutsche Bank. And I was taking care of the Gotha equity fund portfolio, and we also did some loans from the balance sheet of Gotha companies. And then they asked me, Patrick, real estate financing is a nice topic for institutional investors, but CMBS was gone. So I was heavily involved in the CMBS market on the buy side before, but it was gone. So what will be the new product? And there will always be a successor of such a product. In this market, it was on the active side, the debt fund, and on the passive side, Deutsche then issued a lot of Schuldscheindarlehen, you may heard about. I think it's more than 10 billion. No? And this was a bit of a successor of a CMBS because it was well known to German investors as a kind of product. But from the foreign market, it was not that visible. And of course, also in the background of a loan transaction, there is a lot of securitization happen in Luxembourg to, let's say, to put it in another form, to put it in another bucket within an insurance company portfolio, to call it like that. But it's not traditional securitization, that's why I'm asking for. I would doubt whether the passive approach of a security agent and a servicer and a special servicer which charged you twice but doing nothing, if this system will successfully return, I would doubt, to be honest.
Yeah, but I think some bigger players need to keep a securitization market alive, yeah. So like the Blackstone of this world, I think they are still keen to keep that still going on. I just saw a German transaction from a American bank structured, and they told us they did a dual track, yeah, either securitization or syndication market, and they've decided now to go with syndication market in this case, yeah, and they had already a rating available for the securitization track, yeah, so it looks like that people are looking more into that, but will they come back in these sizes what we have seen before GFC? I would say no, because we have other good alternatives in Europe, I would say.
Did you want?
Yeah, maybe just a quick note on that. As you might know, Starz did the first CRE CLO after the financial crisis in 21. I would say, it's an option. If it's there, why not use it? But the market has to be there. And I think in Europe, it's more windows of time where there's enough liquidity and money and demand for that kind of product. So it's not as constant as, for example, in the US, where you have, a larger investor pool. So yeah, I wouldn't take it off the table, but I think it always depends on, whether it works structurally for you and whether the market is there and it makes sense.
Okay, good. Any others? Let's just pick up with a final question then, which is, I suppose, how do we see the outlook in terms of the debt finance markets, and also would be interested to see whether or not we think, pricing, loan to value, margins are all going to be around where they are now, or whether we see any real movement in that as we go into 2026. So this is our look forward at 2026 and what do we think is going to happen. Where should we start? Let's start with you, Filip, this side, and then we'll work our way down.
Okay, I think what we will see is that there will be more players, more debt funds probably, in the area which I would say is between 6 and 8% per annum in terms of interest rates, which will help to close some of the financing gap which we talked about. And there will be more competition among debt funds in altogether in Europe, I think, which may also result in higher competition. Usually results in better pricing for the recipient of the service. So there may be, more attractive terms going forward. I would think, and I think at Expo everybody seemed to agree that we are at the beginning of a new cycle. So that may also, help to get traction on the ground and with new transactions which may be more frequent in the coming months. I think I see a market which is developing, and I see more and more players coming into that market, and established players like the ones that are sitting with me on the panel. I think they will have, it's an attractive time for them because they are already in the market. They have new funds raised. So I think we can. I'm looking into a brighter future for the market, which is not a big surprise given the not so bright past in the last couple of years.
Great, Simon.
Yeah, for me the big question is whether those green shoots turn into blooming flowers, or whether we will sit here next year and discuss the same issues. I'm optimistic. I think there's an increasing pressure also on borrowers with existing facilities to act, amend and extend, I think, also has a limit. And we need more activity in order to get the market going. And I think from a risk-return profile, on the equity side, it's attractive to come in at the right price point. And also, I still believe on the debt side, on a risk-adjusted basis, it's a good point to invest.
I fear that what we see currently in the UK, what we just described, is going to replicate throughout the rest of the continent. So I can see that loan-to-values are going to go up, while pricings might have a downward pressure, and that's really too bad because it means that in relative terms we're going to earn less money. And then I just hope that transactional markets are going to come back. So it's a bit boring to deal with, every 2 years you take a look at the same files, and again you have the same discussions and talks with your clients, which is of course a great business because you know it, and then refinancings are just great to deal with, but also a bit dull. So I would hope for the transactional market to come back a little sooner. And but then again, you never know what might happen in geopolitical terms and what might cause, inflation to spike, and it might then again exercise some pressure on interest rates, and there we are again back to square one. So let's see.
Okay, great, Jürgen.
Yeah, I think where equity is coming slowly back also to the German market, and especially value add and core plus equity is coming back, which translate into normally higher need of higher debt quantum, I would say, higher leverage points, as you mentioned, and it's very crowded on the debt side, so pricing is still under pressure, structure is under pressure, so it's not only fun for us on the debt side, but I think it's good for borrowers for the right product, and the debt market is not the bottleneck.
Beside fundraising being the bottleneck, and always has been the bottleneck for debt funds like us, I think that lending discipline should be a focus, because it already started, not pricing-wise only, but also covenant-wise. And if I hear for development financings, for example, there are also parties in the market where you can draw a tranche later on with equity pari passu as a rule, so that the equity necessary to keep the LTC or LTV in line has to come in at the same point of time, so later than at the starting point where you draw. And also equity last I heard about, which I do not get at all, to be honest, as a debt provider. So these type of lending discipline topics already popped up, and it's very early in the cycle that they already showed up themselves. So this is a bit of a fear I have, to be honest, that this will be the real pressure beside pricing, which I don't mind that much, but yeah.
Okay, good. So a mixture between cautious optimism and a little bit of fear. So we'll see what happens in 2026. thank you to everybody here for sharing your insights. Thanks very much to everybody who's joining online, and if you're joining on demand, thank you for watching. Thank you for your questions. There's now networking outside, so you've got half an hour to ask questions you maybe didn't want to ask in public. You can ask in private. Thanks very much, everybody, and I look forward to talking to you with a coffee in my hand. Thanks very much, everyone.